Hello number curious friends. Today we go beyond calculating net working capital and learn how to analyze it like an expert. Well, we start. By the end of this video you will know what to look at in net working capital, how to compare it between years and which KPIs are especially useful in the analysis. And we will do this with the examples from our Apple shop. But before we start, if you find our videos useful, please take a moment to hit a like button, subscribe to our channel or leave a comment. That's very important for the channel, and thank you for being with us. So, how do we analyze net working capital? To simplify things for now, we will look at trade working capital only, skipping other assets and other liabilities. We will come back to them later. Let's start with the year-end snapshot. At the end of the year, we look at the following classical components of trade working capital: inventory plus receivables minus payables. But now we don't stop at the total amount. We break it down into components and proportions, as only they can tell us what is going on with our business. Let's have a look how our Apple shop is doing. As of December 2025, we see that we have inventory of apples and jam $120, trade receivables $400, trade payables $150, and that gives us net working capital of 120 plus 400 minus 150 equals $370. What can this structure tell us at this point of time? We see that we have a positive net working capital. That means we have $370 of cash tied up in it and have to fund it. That's what we can tell. Otherwise, it is a static value. Not a lot, right? Can we already answer the following questions? Is inventory too high? Are receivables too high? Are payables too low? It is really difficult to answer those without further insights, so we need to compare our balances with something. The first thing we could do is to compare our current net working capital with the values we had last December. Let's add another data point for December 2024, where we had the following: inventory of apples and jam 100, trade receivables 300, trade payables 80, and total net working capital of 320. So, net working capital increased from 320 last year to 370 this year. This means we have $50 more locked in it. What exactly drove it? To make the comparison easier, let's put it into a table and onto a stacked column chart. Here we see that the key driver were trade receivables. They increased by 100. In addition, inventory grew slightly, and the increase in payables by $70 was not enough to offset the increase in assets. Is it good or bad? What do you think? Drop your view in the comments to this video. Well, it's too early to say. We need further insights. For example, maybe the increase in net working capital was related to growth in revenue? Let's check it out. Our revenue in 2025 was $2,150. In 2024, it was $1,550. Does it justify the growth in net working capital? The quickest way to check it is to calculate net working capital as percentage of revenue. Dividing 370 by 2,150, we get 17% for 2025. Dividing 320 by 1,550, we get 21%. So, despite the growth in net working capital, we see that we were able to decrease net working capital as percentage of revenue from 21% to 17%. That means that in comparison to revenue, this year we were able to release more cash from net working capital. Good news for our liquidity. How exactly did we manage to do that? Let's have a look at individual components of net working capital and recalculate the days outstanding. We start with inventory. To calculate days inventory outstanding, we need cost of goods sold. Let's assume our cost of goods sold was 60% of sales. In dollars, that would be 2,150 times 60% or 1,290 in 2025. And in 2024, it is 930. So, our days inventory outstanding in December 2025 will be 120 divided by 1,290 times 365 equals 34. In December 2024, they were 39 days. A decrease of 5 days, which is more than 10%. quite an improvement. Now let's move to receivables. To calculate days sales outstanding in December 2025, we divide 400 by 2150 and multiply it by 365. The result is 68 days. In December 2024, DSOs were correspondingly 71 days. The decrease in DSO is an improvement, similar to DIOs. That means we were able to extract our cash from net working capital faster. Now let's check days payables outstanding. In December 2025, they are 150 divided by 1290 times 365 days equals 42 days. In December 2024, they were 31 days. DPOs increased very significantly. Is that good or bad? It is good. That means we were able to pay our suppliers later and kept our cash in our business. Let's bring in all the numbers into a summary table. So, in all components, DIO, DSO and DPO, we saw an improvement in December 2025 as compared to December 2024. And our cash conversion cycle dropped from 78 days in December 2024 to 59 days in December 2025, by 20 days. That means we collected our cash approximately 3 weeks faster. To make our analysis even better and more informative, we can look back 3 years and add December 2023. Here we go. A trend becomes more visible, and the more data points you have, the better conclusions you can arrive at. Now we see that the declining trend in cash conversion cycle was evident in all 3 years. However, here you can also spot that management of receivables became less efficient. DSOs went up from 65 in December 2023 to 71 days in December 2024, and they were still higher at 68 days in December 2025. This was offset by the significant increase in DPOs. Probably something to investigate and check why it takes longer to collect cash from customers, and also to check whether our suppliers are not very disappointed with our delayed payments to them. We don't want to hurt our relationship. And that's how 3 years will look on the chart. It becomes more visual and helps to track the development of net working capital over time. That's how we come to the most important part of the analysis, conclusions. Good signals for the net working capital development normally are stable or declining net working capital as percentage of revenue, decrease in DSO and DIO and increase in DPO, predictable seasonal patterns. At the same time, warning signs are net working capital growing faster than revenue, increase in receivables which may mean collection issues, rise in inventory which may mean demand problems, fall in payables which could result in cash pressure. Sometimes, companies improve cash position by delaying payments to suppliers, which results in higher DPOs. This, of course, boosts cash in short term, but may hurt relationship with suppliers. Efficient net working capital management is very important for the businesses. You will need to be able to improve your cash position as much as possible without damaging relationship with customers and suppliers, as well as avoiding any stockouts if you decide to go to minimum inventory levels. Let's summarize it. Net working capital analysis helps you answer key questions. Is the business growing efficiently? Is cash being managed well? Are there any signs of trouble? This is why investors and analysts look at working capital very closely. And that's your first insights into analysis of annual net working capital. In the next video, we will dive deeper into monthly numbers and impact of seasonality. Also, I will keep publishing accounting quizzes on the channel's Patreon. Check them out. The link is in the description. If you have other questions, post them in the comments below. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so that you don't miss the next video. See you soon and keep those debits equal to your credits.